Let's move on to our final Your Stock, Our Take. It's Perion Networks, PERI on the NASDAQ. And we're going to be sitting down with management sometime next week.
Yeah, so it will be an interesting talk regardless of the outcome, I would say, just because they've had such a turbulent year. Really, the past, I think, about 9 months. I think it was in April when they had their first big drop, their first change. And that's what we'll get into in this and see where we're at more than anything. So if you're not familiar, Perion Networks, symbol PERI on the NASDAQ, is a provider of advanced technology for digital advertising. The company offers solutions for connected TV or CTV, digital out of home or DOOH, social display, video, and digital audio advertisement. The stock is trading at $8.49 a share at $411 million market cap. This is after a collapse in share price over the past year, falling 62%, but it's been relatively flat for about the past 6-7 months now. The first of the two large drops in 2024 was in April, and that was due to changes in Microsoft Bing's changes and to this pricing mechanism for advertisement, leading to an over 30% drop in Perion's guided revenue for 2024 at the time, resulting in a 41% drop in the stock price. The second large drop in June, another change from Microsoft, impacting its search distribution marketplace. Revenue guidance for 2024 dropped another 20% and a 30% drop for the stock price. And they noted that Microsoft Bing was no longer materially relevant to the company. The company has since now shifted to rolling out a single platform model, unifying its brand and technologies under Perion One, where CTV, digital out of home, retail media, social, and open web capabilities are under a single AI-driven platform. The strategy has a focus on AI development for both the customer side as well as operational efficiencies. The goal of it is really to reduce the siloed nature of each of their solutions. They noted, I think it was back to the 90s, some of their software solutions, and it's really to simplify campaigns across all their major channels, just overall making more of an efficient system for both their own internal use and as well as external for customers. So after the Microsoft changes, really, they were more or less forced to pivot to Perion One, and that's the result of it. Shifting to the financials, however, which I will preface with saying these are preliminary as the company has not filed its 20F for the year. They are an Israeli-based company, so they file a 20F once a year instead of a 10K. Performance year over year was just simply pathetic. For the quarter, the big drop being search revenue that relates to the Microsoft Bing changes. It was down 78% to $25.5 million. Total revenue fell 45% to $130 million. EPS down 86% to 11 cents. Operating cash flow down 91% to just $4.3 million. This is really just a culmination of those Microsoft changes earlier in the year and why the stock got hammered so hard. This was expected just to have dismal results after those changes. The company did not renew its contract with Microsoft at the end of the year, but does expect to have some tail revenue, but likely minor into 2025. As well, I will note that the company does have interest income, which supported the quarterly profitability, and without the interest income, it would have actually been a net loss overall for 2024. On the bright side, though, the company's new focus segments did see growth for the entire fiscal year. DOOH revenue grew 50% to $69.7 million. CTV grew 30% to $43.6 million. And the retail media vertical, that is, grew 62% to $80.6 million. So where they're actually focusing now did at least have growth for the year, but obviously only a tiny bit of a bright side when you're looking at such dismal results. What I will highlight is another one of their strengths, though, is their extremely strong balance sheet with a net cash position of $373 million. Mind you, the market cap is only $411 million. That is a $38 million enterprise value. Past operations, the company is looking to buy back shares with its cash, just today increasing its buyback authorization to $125 million. That's a $50 million increase, which it had previously bought back $46.9 million in shares. Buying back a large amount of shares is not really uncommon for when a company is trading at near cash values, as if they don't have a really great use for cash, that's what they'll do. They'll just buy back shares for effectively the same price that their cash is trading at. It's a way to return capital to shareholders. The other potential use is acquisitions to build out Perion One, but the company has stated that they are primarily focused on organic growth at this time. So we'll see if they do end up finding something that fits perfectly, synergizes with their Perion One platform. If not, I wouldn't really expect any acquisition to happen within the year. The company has provided guidance for fiscal 2025, revenue of 400 to 420 million, implying 18% year-over-year growth from the midpoint, adjusted EBITDA of 40 to 42 million, implying a decline of 19%. Oh, sorry, that should have been 18% decrease year-over-year for revenue as well, and a decline of 19% for EBITDA. And an ex-TAC or traffic acquisition cost, adjusted EBITDA margin of 22%, a 2% drop year-over-year. So overall forecasting another year of decline, but that's not unexpected given the company was still benefiting from the Bing advertising through part of 2024. They still need to lap those numbers. The company did note that they do not expect the reorganization to be really reflected in the financials until at least the second half of 2025, and not really having the full changes reflected in the financials until 2026. So you're still looking at another full year of financials that are likely going to be weaker overall, but you might see a bit of growth at the latter half of the year. Using the company's guidance, the valuations are EV/EBITDA of 0.9 times, the price to sales of 1 times, and X cash. If you're looking at X cash to sales, so EV to sales, it's only 0.1 times. Obviously, very cheap on a purely valuation point basis, but the company is contracting and has significant risk with the reorganization of their solutions and products as a whole. So right now, Perion just doesn't fit our investment criteria. The company is not growing, it's contracting, if anything. Perion has highlighted really two concepts that I want to highlight myself, I should say. One being customer concentration with Microsoft. That's always a risk, and that's why when you do look through a company's financials or you do read a report or wherever you may see, and they do have a massive customer concentration, this is the risk actually happening. It's when Microsoft made their changes completely out of Perion's control, and it just has devastated the business and your investment. As well, the other factor I want to highlight is just how much cash can matter for a company. The enterprise value being only 38 million, meaning the value of the cash is roughly 10 times what the market is currently valuing the future operations of the company at. That is just massive. And if they didn't have that cash, they would likely be trading at that $38 million market cap instead of the EV. So that strong balance sheet really saved the investment's downside. And that's why when we're saying that there's really a baseline to a company, and when you look at the balance sheet, that is the structure to your company. That is your foundation to it, and it can't go much below that. Otherwise, someone will acquire, they will do buybacks, and that is returned to shareholders in some manner. Obviously, that's not always the case. So in Perion's case, if they do, let's say, do a poor acquisition, even though they say they're only going to do one that has their synergy requirements, if they did a poor acquisition and they spent 200 million of their capital on it, and that just falls apart, that can obviously have quite a bit of downside right there. As well, what I will note is it now looking forward, if we can see the company actually continue to grow that CTV and the DOOH channels, as well as the retail vertical, those core focuses what they want to hit. And if it can hit its guidance for 2025, it could be appealing. But that is really what we need to see. And it is an uphill battle as there is the recession fears right now, which will impact in advertising demand. So that's even something out of their control, which could hurt the company in the next year. But Perion's growth is much, much more in their own hands compared to the prior years, as they aren't more or less subservient to Microsoft anymore, meaning a major risk is management's execution now. But if they can execute, there can be a major reward. But obviously, that's what you need to see, and that's really what we'll be questioning them about in the next week when we do speak to them. As we need to see the plan, then we need to see them actually hit those results, hit their goals, hit their targets, financial as well as operationally. But for now, we'll just continue to monitor the stock.
Yeah. I mean, it definitely becomes intriguing trading close to just cash value. And again, I understand we're probably going to be posting some weaker results. And, I ended up writing up a report. We interviewed this company back in 2022 at the same conference, and did up a report. And, essentially, I wrote, overall Perion does screen well, but, given the large customer concentration risk with the Microsoft agreement, we will monitor the business at this time. I think that at that point, it was about 50% of their market cap was in cash. So, still a significant amount, which, like Brett, I'm glad that you said that, it can act as kind of like a bottom for the stock, having some of that like a cash balance. If this company didn't have that large cash balance, it probably would have been trading, even way significantly lower, couple bucks or something along those lines. But that was the thing when we were looking at this stock in the past. It was just, is there that asymmetrical risk to reward where we're seeing, more reward than risk? And because of that customer concentration, we were seeing potentially more risk than the potential reward that was there. So, we continue to monitor the business, but it will be interesting to, hear right from management, what they're planning on doing here going forward, what they're going to try and target for organic growth, if they do have a target that they're willing to share. But yeah, good job, Brett.
I want you guys to ask what they think they can acquire realistically with that money, like what's out there, because that's interesting. Like that to me, I mean, the buybacks, it's nice to see that you don't just want to be sitting there with a bunch of cash on your balance sheet forever, right? So it's good to see that they are returning some of that capital back to shareholders. But really, I think what people are going to, what can really propel the stocks if they could acquire something quite interesting. But I don't know what there is out there that would be in their wheelhouse. I mean, obviously it would need to be something aligned with their business that would add value. Hopefully, not too risky, but yeah, that's what I want you guys to ask.
Yep.
Yeah. And we point out too that they're based in Israel, right? Mm-hmm. So there is a higher level of risk that's associated.
Well, there's a discount.
Lower multiples. Yeah. Lower
multiples.
multiples.
And especially now.
Yeah.